What if I told you that right now, in this exact moment in financial history, the conditions that created the most violent, most explosive precious metals event of the 20th century are not just repeating, they're actually worse. Measurably, provably, structurally worse. And the people who understand what's happening are quietly positioning themselves while the rest of the world argues about stock prices and interest rates and whatever political theater is dominating the headlines this week. I want to tell you a story, and I want you to pay very close attention because this story begins with two brothers in Texas, runs through a winter that shook the global commodities markets to their foundation, and ends with a warning that is unfolding right now in the silver market that almost nobody is talking about at the level of detail it deserves. The year is 1979. Nelson Bunker Hunt and his brother William Herbert Hunt have been quietly, methodically accumulating physical silver for years. They understand something that most traders and most investors simply refuse to believe, that the paper promises circulating through the financial system dramatically outnumber the real, physical, tangible metal that actually exists. They begin stockpiling silver bars, hundreds of millions of ounces. At the height of their operation, the Hunt brothers control an estimated one-third of the entire world's private silver supply. And what happens next is the stuff of legend. Silver, which had been trading around $6 an ounce, begins to move, slowly at first, then with gathering speed, then with the kind of momentum that starts drawing in other players, speculators, traders, ordinary people watching their neighbors make fortunes. By the time the move fully ignites, silver is screaming toward $50 an ounce. In a matter of months, one of the world's most important industrial and monetary metals had multiplied in price by nearly 800%. Then the exchanges changed the rules mid-game. COMEX and CBOT enacted something called Silver Rule 7, which essentially restricted new silver purchases to liquidation orders only. The Hunt brothers, leveraged to the hilt, couldn't meet their margin calls. Silver crashed. Fortunes evaporated. And the brothers who had tried to corner the silver market ended up filing for bankruptcy. But here's the part that gets buried in every retelling of that story. The reason the squeeze worked, the reason silver could move that violently, that fast, wasn't just because the Hunt brothers were rich and aggressive. It was because the underlying structure of the silver market contained a deep, dangerous imbalance between paper claims and physical reality. The Hunt brothers didn't manufacture that imbalance. They simply found it, recognized it, and tried to exploit it. And right now, that same imbalance exists again. Only this time, nobody engineered it. It emerged organically through years of structural deficit, relentless industrial consumption, and the quiet mechanics of a futures market that has been allowed to balloon far beyond any reasonable relationship to the physical metal underpinning it. Let me give you the numbers, because the numbers are staggering. The global silver market has now recorded 6 consecutive years of supply deficits. 6 straight years where demand has outpaced every ounce that the world's mines can pull from the ground, combined with all recycling activity. Over the past 5 years alone, more than 760 million ounces of above-ground silver stocks have been consumed and not replaced. That's not a rounding error. That is hundreds of millions of ounces of real, physical, deliverable metal that has been consumed by industrial processes, electronics manufacturing, renewable energy infrastructure, and investment demand, and simply does not exist anymore in accessible stockpile form. Meanwhile, the paper market, the futures market, the layer of financial contracts that theoretically represents silver, has been allowed to grow and grow and grow. And right now, the ratio of paper silver claims to actual physical silver available for delivery has reached levels that should alarm anyone who understands what that means. Industry analysts tracking COMEX warehouse data and derivatives positioning have documented a paper-to-physical ratio approaching 350 to 1. 350 paper claims for every single ounce of physical silver that could actually be delivered if those contracts were presented for settlement. Think about that for one moment. If even a small fraction of the institutional players holding paper silver contracts decided they wanted the real thing, not a cash settlement, not a rolled contract, but actual physical bars, the current inventory levels would be exhausted in days, not weeks, days. And here's where this gets even more urgent. Because something happened at the beginning of this year that most mainstream financial commentators completely overlooked in the noise of everything else going on. China, which, according to multiple industry analyses, controls somewhere between 60 and 70% of the world's refined silver processing capacity, implemented new export restrictions. They didn't ban silver exports entirely, but they created a licensing system where only large, state-approved entities meeting strict criteria can export silver. Effectively, they built a regulatory wall around a majority of the world's refined silver supply and told the rest of the world, you need to work harder to get this. The timing of that announcement cannot be seen as coincidental when you understand the broader geopolitical context. We are living through an era of de-dollarization, of BRICS expansion, of nations actively trying to reduce their dependence on dollar-denominated financial systems and dollar-controlled commodity pricing mechanisms. Silver isn't just a precious metal anymore. It has become a strategic industrial material, and increasingly, central banks from emerging market nations are beginning to treat it like a monetary reserve asset. Before I go any further, if you're watching this and you have retirement savings of any size, I want you to check the description below this video. There's a free guide down there that breaks down the saving strategies that thousands of American retirees are quietly using to protect their hard-earned wealth from the kind of monetary disruption we're discussing right now. It costs you nothing. Just check the description. Now, back to where this is heading. The London Bullion Market Association, which handles the vast majority of the world's physical silver trading and vault operations, has been watching its available inventory shrink to historically thin levels. When you strip away all the silver that is already spoken for, already allocated to industrial customers, already committed to delivery contracts, already sitting in allocated accounts, the amount of unencumbered, freely available silver in London's vaults is extraordinarily tight. Lease rates, which are essentially the cost to borrow silver for short-term operational purposes, have in recent months spiked to levels not seen in decades. When lease rates spike, it means the physical market is screaming, we need metal, and we don't have enough. The last time lease rates spiked anywhere close to these levels was around the 2011 silver run, when silver went from roughly $18 an ounce to nearly $50 an ounce in the span of about 8 months. That run ended when the CME Group raised margin requirements 5 times in a matter of weeks, similar to the rule change that broke the Hunt brothers. The same playbook, the same result. But it didn't break the structural deficit. It just temporarily postponed the reckoning. Here's what's different now. In 1979 and 1980, silver was largely a monetary metal and a photography metal. The industrial demand base was significant, but not overwhelming. You could, theoretically, reduce demand for silver if price got high enough. Photographers could hold off on buying film, jewelers could scale back. But today's silver demand is dominated by applications where price sensitivity is extremely low. Solar panels, electric vehicles, semiconductor manufacturing, medical devices, advanced electronics. The engineers who design these systems don't get to choose whether they want to use silver or switch to something cheaper. There is no adequate substitute for silver in many of these applications. The conductivity, the antimicrobial properties, the reflectivity, these are irreplaceable characteristics. And the industries consuming silver at this rate are not optional lifestyle purchases. They are the backbone of the global energy transition, of defense technology, of medical infrastructure. Solar panel manufacturing alone consumes somewhere in the range of 100 million ounces of silver per year, and that number is climbing as installed capacity continues to expand globally. Every single time someone puts a solar panel on a roof or a utility company builds a solar farm, silver disappears into those panels permanently. It doesn't come back. It doesn't get recycled efficiently. It's gone from the tradable supply forever. Electric vehicles use silver in their charging systems, their electronics, their battery management technology. The more EVs the world produces, the more silver gets locked away in long-lived assets that won't release that silver back to the market for decades, if ever. When the Hunt brothers tried to squeeze silver in 1979, industrial demand was consuming roughly 300 million ounces per year. Total annual demand, including investment, was manageable. Today, total global silver demand is running well above 1 billion ounces per year. Mine supply is barely covering 800 million ounces in the best years. The structural deficit isn't a recent development. It's been compounding year after year, chewing through the inventory buffers that used to provide the market with cushion. Now, here's the mechanics of how a real squeeze unfolds, because I think a lot of people watch silver and think they understand it, but they don't fully grasp how the COMEX paper machinery actually works and why the current setup is so precarious. When large financial institutions, banks, hedge funds, commodity trading houses, want to participate in the silver market, they almost always do it through futures contracts rather than by buying and taking delivery of physical silver. It's cheaper, it's more liquid, and it lets them take much larger positions with much less capital. These contracts are written with the theoretical option to take physical delivery at expiration, but in practice, the vast majority of futures contracts are settled in cash or rolled forward to the next contract month. The exchanges and the major players have always relied on the assumption that almost nobody actually wants the silver. They just want the price exposure. But what happens when that assumption breaks? What happens when a critical mass of contract holders, maybe because lease rates have spiked and borrowing real silver has become prohibitively expensive, maybe because geopolitical supply disruptions make physical possession feel suddenly urgent, maybe because enough institutional players look at a 356 to 1 paper to physical ratio and decide they want to be the ones holding real metal when the music stops? What happens when those players demand actual delivery? The answer is that the exchanges face what's called a force majeure scenario, a situation where the obligation to deliver physical silver cannot be met. And in that moment, the price discovery mechanism of the futures market breaks down. The paper price and the physical price bifurcate. And the physical price, the price someone actually pays for a real silver bar that can hold and store, goes somewhere that the models don't predict and the algorithms don't anticipate. This is not theoretical. We have seen versions of this play out in other commodity markets. We saw it in crude oil when WTI futures briefly went negative during a period of extreme inventory stress. We saw elements of it in the gold market during the COVID supply disruptions when the price spread between London spot and New York futures blew out to historic extremes because traders couldn't physically get metal from one place to another fast enough. Silver's market structure is arguably more fragile than gold's at this moment, because silver's industrial consumption makes it genuinely irreplaceable, because the supply base is dominated by byproduct mining from copper, zinc, and lead operations that don't ramp up production in response to silver prices, and because the concentration of refined supply in geopolitically sensitive regions creates a vulnerability that didn't exist in previous cycles. Look at the mine supply situation honestly for a moment. Approximately 2/3 of all silver mined globally is produced as a byproduct of mining other metals. The mines aren't digging for silver, they're digging for copper or zinc or lead, and silver comes out as a bonus. This means that the economics of silver mining are largely decoupled from the silver price itself. A mine won't open a new copper shaft just because silver prices are rising. The metal comes when it comes, on a timeline dictated by the primary metal economics. This structural rigidity of the supply side means that demand increases cannot be met by the usual market mechanism of higher prices incentivizing new production. The supply curve for silver is unusually inelastic. Higher prices don't bring meaningfully more silver to market in any reasonable timeframe. Now, layer on top of all of this the monetary environment. Global debt levels have reached magnitudes that would have been considered science fiction a generation ago. Central banks that spent years as net sellers of precious metals have flipped into aggressive net buyers. The dollar's reserve currency status, while still intact, is being challenged in ways that would have seemed fringe just a decade ago. Trade blocs are settling transactions in currencies other than dollars. Nations are repatriating gold. And increasingly, silver is being reconsidered not just as an industrial input, but as a monetary reserve asset, a role it played for most of human history and was only stripped of it within living memory. And this is actually the right moment to talk about something practical, because everything we've discussed matters in a very personal way if you're approaching retirement or already in it. When your retirement savings are held entirely in dollar-denominated assets, stocks, bonds, mutual funds, you are exposed to every single one of the systemic risks we've talked about in this video. A dollar that loses purchasing power erodes your savings silently, without any headlines, without any drama, just quietly, month by month, year by year. Market volatility can wipe out years of gains in a matter of weeks, as anyone who has watched their retirement account during a major correction can attest. Geopolitical instability, trade disruptions, banking system stress, all of these things can trigger the kinds of sudden, severe drawdowns that retirement savers simply cannot recover from when they don't have decades left to wait for markets to recover. A gold IRA gives you a way to hold physical precious metals, gold and silver, inside a tax-advantaged retirement account structure. You get the same tax benefits you're already familiar with from your existing retirement account structure, but instead of paper assets, you're holding real metal that has maintained purchasing power across centuries, that governments cannot print into worthlessness, and that moves inversely to many of the risks that threaten traditional retirement portfolios. If you have substantial retirement savings and you've been watching everything we've talked about in this video and thinking, maybe I should have some real exposure to this, then looking seriously at a gold IRA is worth your time. The structural case for precious metals in a retirement portfolio has rarely been stronger than it is right now, given what's happening to supply, demand, monetary policy, and geopolitics simultaneously. Let me bring this back to the bigger picture, because there's something I want to make absolutely clear before we close out. The Hunt Brothers squeeze of 1979 and 1980 was a manufactured event. Two very rich men deliberately tried to corner a market. The squeeze we may be witnessing building right now is entirely different in character. It is not the product of any one actor's ambition. It is the organic consequence of 6 straight years of supply deficits, of a paper market that has grown to hundreds of times the size of the physical market it supposedly represents, of industrial consumption that is structurally incapable of being reduced, of geopolitical fragmentation that is restricting supply flows across national boundaries, and of a slowly awakening awareness among institutional capital allocators that the silver market's paper-to-physical ratio is a ticking mechanism. The Hunt Brothers squeeze ended when the exchanges changed the rules and the regulatory apparatus came down on them. This time, there are no Hunt Brothers to blame. There's no single entity to margin call into oblivion. The structural deficit is real. The industrial demand is real. The inventory drawdown is real. And when the markets finally fully price in what's actually happening in the physical supply chain, the price response will not be some temporary spike that corrects when a regulatory authority intervenes. It will be a repricing, a fundamental, sustained acknowledgement that silver at current levels, relative to its industrial importance, its monetary history, and its supply constraints, is one of the most mispriced assets on Earth. The greatest squeeze in history started with two brothers recognizing something everyone else was ignoring. What's building right now is being recognized by sovereign wealth funds, by central banks adding silver to their reserve discussions, by mining company executives who understand their own output data better than anyone, and by the institutional trading desks that have been watching lease rates and COMEX inventory levels with increasing concern. The question is never whether a structural imbalance in a market will eventually correct. It always does. The question is only when, and whether you are on the right side of it when it does. The window to act before broad market awareness catches up to the structural reality is never as wide as people want it to be. History shows over and over again that the periods of greatest opportunity are the periods that feel most uncertain, most uncomfortable, and most easy to rationalize away with reasons to wait. The last time the conditions in the silver market lined up even remotely close to what we're looking at today, those who recognized it early and positioned accordingly watched their silver holdings produce life-changing returns. The silver market does not give out these kinds of setups frequently. When it does, it tends to move fast, and it tends to leave most people behind, because most people are still arguing about whether the move is real by the time the real move is already well underway. I hope this video has given you a clear-eyed look at what's actually happening beneath the surface noise of the Dolly financial markets. Share this with someone you think needs to understand it. The information in this video doesn't get discussed in this depth very often, and the people who are positioned well for what's coming got there by doing exactly this kind of research. And for those of you who stayed with me all the way to the end, I specifically set aside something for you. In the description below this video, there is a link to a free guide. But if you go through that guide and you want to take it a step further, mention that you watched this video to the end when you reach out. Because for American retirees with at least $100,000 in any retirement account, I've arranged access to an exclusive one-on-one educational web conference, completely free, completely no obligation, where you can get personalized guidance on how to think about what we've discussed today in the context of your specific retirement situation. It's only available to people who actually watched this video through. That's the only qualification. If that's you, the details are in the description. Thank you for watching. Stay informed, stay positioned, and stay ahead.